Hi, the Indian markets completed another month of range-bound movement. But the good news is that we feel that the period of consolidation in the markets is reaching its logical conclusion. There are three reasons why we feel that we could be nearing the end of this sideways movement or correction phase. First, if you look at the results from the corporate sector for the last 2 quarters, after a long time we are not seeing any cuts to the estimates of profits for Nifty 50. In fact, there have been marginal upgrades in the earnings this quarter. So what we are seeing now is that after 2 years of very low profits growth for Nifty 50 of 5 to 6% CAGR between fiscal year 25 and 26, we could be entering a period of fiscal year 27 when companies' profits could grow by 15 to 20%. Second reason is that if you look at the valuations for the Indian markets today, Nifty 50 forward price to earnings ratio has come down from 22.5 times last year in July to roughly 21 times now. This makes the valuation slightly more reasonable in terms of the return outlook going forward, especially if you look at it in the context of what I mentioned earlier about the profit growth looking up. Now, why is the profit growth looking up? There are various reasons for it, obviously banking earnings and credit growth, and the fact that there is a low base of consumption this year means that next year could start to look better. Having said that, I think the GST cut and the monetary policy impact and the income tax cuts have started to have a positive impact on consumption in the current quarter and going forward. The third and the most important reason why we feel that the consolidation phase could be getting over is that if you look at global flows in the last 6 to 9 months, it has been dominated by the artificial intelligence wave, which means that India has got very little share of that. Most of the share of the flows, apart from the US, have gone to other emerging markets which are much more exposed to this theme, which is China, Korea, Taiwan, and so on. Now that is looking fully valued. There is a likelihood of some balance returning to flows, especially as India's growth revives. The valuation premium which India had before 2024 was almost 80 to 90% compared to emerging markets, which has now come down to 50%, which is the average of the last 10 years. So this could be a good level from a global point of view. All in all, I think a combination of the fact that we are seeing the profit estimates for the Indian corporate sector recovering, coupled with the fact that our premium to global valuation has come down, makes us slightly more optimistic about Indian markets going forward in the next 12 to 15 months. Our fund preferences remain the same. A flexi cap in the diversified category, multi-asset in the hybrid category to get the exposure to commodities, and in terms of thematic funds through banking and consumer funds.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.